Hi and welcome to Module 2, 2070 Project Evaluation. For this lecture slides, we're going through part 1. So we look at the methods that we use to evaluate investment projects. So the lecture outlines as follows. We have 3 parts in this lecture. In the first part, we introduce the capital expenditure process. In the second part, we look at a certain group of project evaluation methods where we use the discounted cash flow methods to evaluate projects. So with this theme of with this group of methods, we take into account the time value of money when we price certain projects. Yeah. And finally, we look at non-discounted cash flow methods. So these methods, the common theme of these methods is that it's based on accounting figures rather than the time value of money. So we'll see that the methods that we talk about in part 3 is a bit more simple than the methods that we talk about in part 2. So with this topic, the 2 important methods that we focus on are the NPV method, or the net present value method, and the internal rate of return method. So in terms of the learning objectives, as we mentioned before, we introduced the capital structure process, the capital expenditure process, where we look at different investment methods, investment projects, and we try to choose which project is the optimal project to invest in. We then look at different decision rules for individual methods of project evaluation. We then assess the advantages and disadvantages of different methods. We look at the differences between discounted cash flow methods and non-discounted cash flow methods. We then explain the principles used in estimating project cash flows. And finally, we look at why we tend to prefer the net present value method over the other methods. Yeah. So with part 1, we introduced the capital expenditure process. So I'm going to be brief here. So the objective of the investment decision is to maximize shareholders' wealth. So with investment decision, we want to choose the project with the highest returns. So the capital expenditure process involves the following steps. We first look at investment proposal. So we first go out and see what are the available investments that we can invest in. We then try to evaluate, we then try to work out the values of these different investment projects so that we can pick the best one, right? So once we pick a project, we then control the process of capital expenditures. And finally, post-completion, audit of the investment projects, right? So for this topic, we are focusing on step 2. So we're trying to see how we can evaluate different investment projects. Okay. So part 2 is quite important. So we mentioned before that for this topic, we focus on 2 methods, the NPV methods and the IRR method, being the internal rate of return method. The reason being, so later on we'll look at some statistics, and we'll see that CEOs, they tend to prefer these 2 types of project evaluation methods. So with the discounted cash flow methods, as the name suggests, these methods take into account the time value of money when they evaluate the value of a certain project. Yeah. So we have 3 methods under this theme. We have the net present value method, the NPV method. We then have the internal rate of return method, and then we have the probability index. So they are all quite similar and they are all related. And the key point here is that we take into account the time value of money. Yeah. So let's go through the net present value method. So the idea under this method is quite simple. This is more like a cost and benefit approach, right? So what we're doing here is that we're looking at the initial investment outlay. So if we were to invest $1 million today, and in the future we get, say, 5 different cash flows, do the cash flows in the future at least are able to cover the cost that we invest in the project today? Yeah. So the net present value method, look at the net value of the future cash flows after deducting for after accounting for the initial investment that we make in the project. Okay. So the net present value is just the difference between the sum of the present values of future cash flows and the initial investment. This is expressed in this formula here, where C0 is the investment, is the initial cash outlay. So today we invest $1 million, for example, in PHP, right? CT are the future cash flows. N is the life of the project, and K here is the required rate of return. So the discount rate that we use to discount the future cash flows. Yeah. So we can think of the net present value as the sum of cash inflows minus the sum of cash outflows. Yeah. So the cash inflows are profits, right? Revenues coming from sales, revenues coming from the operations of the firm. Cash outflows include investments, yeah, so expenditure on materials, labor, and manufacturing, right? And other expenses, yeah. Required rate of return or discount rate. So the discount rate that we use to discount future cash flows in the NPV method reflects the opportunity cost of capital. So suppose that we are the shareholder. If we decide to invest in this project, we forego the opportunity to invest in other different projects. Yeah. So if I can put my money into the bank and earn 5%, but if I decide to invest in PHP, then I lose the 5% that I get from the bank account. Yeah. So the 5% is my opportunity cost. Yeah. Therefore, if the market or if investors invest in the firm, the expected return that we use to discount cash flows reflect the opportunity cost that the investors have to forego when they pick our projects relative to the other projects. Yeah. NPV graph to see what it means. So this is a graph that we saw before. This is the relation between the NPV and the required rate of return, or K, yeah, in our model. So in general, when K increases, NPV decreases, yeah. At this point here, this is when the NPV is equal to 0. So this rate over here is there for the project's IRR, yeah? So what do we see here? If K is somewhere here, this is my K. So K is currently K1 here, is less than the IRR. What do we see about the NPV? So NPV is positive, yeah? So when the required rate of return is less than the internal rate of return, then the project's NPV is positive, meaning that this is a value enhancing project. On the other hand, if I have K2 over here, so K2 is larger than the IRR, and at this point, our NPV is a negative number, right? So meaning that if the required rate of return is larger than the IRR or the internal rate of return of the project, then this project is making losses, yeah? So the internal rate of return can be seen as the return on the investment, and K, or the discount rate, is the cost of capital, yeah? So if the cost is lower than the return of the investment, then we have a value enhancing project. If the cost is greater than the value of the investment, then we have a loss making project, yeah? Okay. So given the relationship between the IRR and the required rate of return that we saw before, our decision rule, if we were to use the IRR as our project evaluation method, would be that if the IRR is greater than K, or if the rate of return of the project is greater than the costs of the project, then the project should be accepted, yeah? So we're making a profit here. So because this method gives us a rate, right? This is the rate of return. It could be quite confusing when you do the calculations later on. You see that sometimes you can mix up between the IRR and the discount rate, right? So just be careful in the calculations. Okay. So in terms of calculating the IRR, now we know that the IRR is the rate at which the present value of the future cash flows equates or equal to the initial cost, right? So the IRR is the rate at which our net present value is equal to 0, right? So how do I work out that rate, yeah? So if we go back to the previous example where we have a project with 3 years of life, and these are the cash flows of the project at the end of year 1, 2, and 3. This is the initial costs. The IRR of this project is worked out to be 25%, yeah? So how do we work that out? We could either use trial and error. So we pick a rate that is roughly below the IRR, so a rate where the NPV is positive, and the rate is when the NPV is negative, and our estimate of the IRR would be some number in between of these two rates, yeah? We could also use the financial calculator, or we could use Excel. So we could use the goal-seek function in Excel to work out the IRR, yeah? We have a required rate of return at 20%, and we want to use the IRR method to evaluate these projects, yeah? Now we know from before that the IRR here is 25%. As we mentioned before, we can do trial and error, or we can use GoSeek. I'll show you how to use GoSeek later on in the workshop. Or if we use the financial calculator, so I use this particular model. If you use the same model, then this is how you calculate the IRR using this calculator. Yeah. Or if you don't have the same calculator as me, you can just go to YouTube and search for calculating IRR using a financial calculator and put the model of your calculator in. Okay. The problems with IRR is that firstly, sometimes the IRR doesn't give us just one number, right? So the IRR model sometimes gives us 2 or 3 numbers, yeah? So with conventional projects, a project where you have an initial outlay, which is a negative cash flow, followed by positive cash flows in the future, yeah? So this is what we mean by a conventional project, yeah? So we invest at the start, and in the future we expect to just making profits, right? Making positive cash flows, yeah? So with this conventional project, it's likely that we only get one IRR. However, for non-conventional projects, so projects where we have in some years we make positive cash flows, in some other years we make negative cash flows, right? So for these projects, the IRR, the NPV curve can change, and therefore the IRR can happen many times, right? So this is when we have a non-conventional project, yeah? Okay. So this is a non-conventional project. We have positive cash flows in the first 2 years. We then have a negative cash flow here. Then we have a positive cash flow again, yeah? So it's a bit different from this project here, where all my future cash flows are positive. Okay. So in this case, if it happens, if we have a non-conventional project, we might come up with 2 or 3 different IRR numbers. So it's a bit hard then to choose which IRR to use, yeah? So in this case, the IRR method is not very appropriate. Okay. So for projects with a unique IRR, the decision rule is always that if the IRR is greater than the required rate of return, then we accept the project, yeah? But this can only be used if we have a unique IRR. Okay. So to illustrate the problem of multiple IRRs, this is an example that I take from the textbook. This is table 5.3 in the textbook. We have a project where in year 0, we invest about $14 million. In year 1, the project is expected to earn $34 million. But in year 2, the project is expected to make losses, yeah, of $20 million. Okay. So we have one incident where the cash flow changed the side, yeah. So if we look at the NPV of this project, this is how it looks like, yeah. So this NPV curve here cuts the horizontal axis 2 times, right? So at these 2 points, at either 10% or 25%, my NPV is equal to 0, yeah? Meaning that I have 2 IRRs in this case. So I can't really pick any of these numbers, right? Because they are both correct. Okay. So in this case, I can't really use the IRR method to evaluate this project. Yeah. So this is similar to the example before. In this case, we have at least 2 times where the size of the cash flows change. Yeah. We then look at different types of investment decisions. So we have independent projects and we have mutually exclusive projects. So what do we mean by independent projects? Yeah. So with independent investments, this is when if we invest in one project, we still can invest in the other projects. Yeah. So independent investments are when the decisions can be made independently, right? So if we decide to invest in one project, we don't have to forego the other one. Yeah. So the decision to invest or not in one project would not affect the outcome of the other project. Yeah. Mutually exclusive investments is when we invest in one project, we can't invest in the other project, right? So the decision to invest or not in one project would affect the decision to invest or not in the other one. Yeah. So an example of independent investments is when we have $100 to invest and we have 2 projects in the economy and they can be both produced independently. Project A costs us, say, $20, for example. Project B costs us $40. So in general, my investment, so the funding that I have can be used to invest in both A and B, right? So the cost of investing in both A and B is only $60, but I have $100, right? And because A and B are produced independently, I don't have to worry about exhausting my production lines, right? On the other hand, if I have 2 investment again, but A costs me $100, B costs me, say, $80, yeah? So in this case, clearly I can't invest in both projects, right? I don't have $180, I only have $100. Therefore, if I pick A, I can't pick B, right? Or if I pick B, I can't pick A. Okay. Okay, so for independent projects, the decision rule is quite simple. If we use the NPV method, the net present value method, we accept any project with positive NPVs, yeah? If we use the IRR method and assuming that we have unique IRRs for all our projects, then we accept any project where the IRR is higher than the cost of capital. Yeah. With mutually exclusive investments, this is when we have to make a choice, yeah? So we either pick A or pick B, right? So in this case, the decision rule is if we want to maximize, right, if we want to maximize shareholders' value, we want to choose the project that has the highest value, yeah? So if we were to choose the NPV method, we therefore would pick the project with the highest NPV, right? So for example, if we have 2 projects A and B, and project A has a higher NPV, we would then pick the first project, right? Project A. Similarly, with the IRR method, the IRR shows us the rate of return on the investment, right? On the project, yeah? So if the rate of return of project A is higher than the rate of return of project B, we then pick project A, yeah? So with mutually exclusive investments, we have a preference here for which investment gives the best option. Yeah. The problem here is sometimes different evaluation methods give different ranking. So sometimes the ranking of the NPV is different from the ranking using the IRR. Yeah. So in this case, what should we do, right? We normally stick to the NPV method because the dollar term that we get from the NPV method shows us directly how much shareholder value increases by. Yeah. Whereas sometimes the IRR can give a different picture, right? So why does the IRR method sometimes give a different conclusion compared to the NPV method? Yeah. So what are the problems with using the IRR besides the multiple IRR problems? Okay. So we're looking at two different examples here to see how the IRR method can give a different can give a biased estimate for two different projects. So in this example here, we have two projects, Project X and Project Y. With Project X, we invest $1 today and we expect to get $6 back in year one. With Project Y, we invest $10 today and we get $20 back in the future, right? So using the IRR method, we work out that the IRR for Project X is 500%. The IRR for Project Y is only $100, 100%. Yeah. So using the IRR method, we would then pick Project X. Yeah. But if we look at the NPV, so at 10% discount rate, the NPV gives us $4.45 for Project X and $8.18 for Project Y, right? So in this case, the NPV method favors Project Y, right? So there's a disagreement between the NPV method and the IRR method. Yeah. So what this number shows is that if we invested in Project Y, the company's value is going to be increased by $8.18. Whereas if we pick Project X, the company's value is only increased by $4.45. Yeah. So clearly we see that the firm value would increase by more if we choose Project Y. Yeah. So this is why we always stick to the NPV method whenever we have a disagreement between different projects, different investment methods. Yeah. So the second problem, we talked about the first problem before in the first example, where the scaling of cash flows for different projects would bias the IRR estimates. In the second example, we're trying to illustrate how the timing of different cash flows could affect the IRR estimates. Yeah. So we once again have a disagreement between the IRR method and the NPV method. So with the IRR method, it prefers large cash flows happening earlier, right? So if we have projects where the larger cash flows happen earlier, then our IRR would be higher. Whereas for projects where the large cash flows happened later, then the IRR is smaller. Yeah. Whereas the dollar value of the project gives a different picture. Yeah. We have the third method under the discounted cash flow method. This is the benefit and cost ratio or the profitability index. Yeah. So how is it calculated? Yeah. So the benefit and cost ratio is simply just the sum of the present values of future cash flows divided by the initial cash outlay. Yeah. So the NPV method is the sum of the present values of future cash flows minus the initial outlay. This benefit cost ratio is similar. So they have similar inputs. They just have a different way of expressing it. Yeah. So the decision rule here is therefore we want to choose projects where the future benefits outweigh the initial costs. Yeah. Therefore, we want to pick projects where the profitability index or the benefit cost ratio is larger than 1, right? So if this ratio is larger than 1, it means that the value of the future cash flows is larger than the initial cash outlay. Yeah. And vice versa, right? So we reject projects where the benefit cost ratio is less than 1. So to summarize, with the discounted cash flow methods, we have 3 methods. We have the net present value method, being the most important and most commonly used one. We have the internal rate of return method, which is quite similar, and it gives us an estimate of the average rate of return on the project. It does have some problems, but it is also a very popular evaluation method. We then talk about the benefit cost ratio. It's basically just the NPV expressed in a different way. Yeah. But with the NPV, the advantage here is that we show the exact dollar number that the project brings to the firm value, whereas with the benefit cost ratio, it doesn't tell as much, right? So they have one thing in common, right? They take into account all the cash flows in the future, and they take into account the time value of money. Yeah. What are the decision rules? So the decision rule here is always choosing the project with the highest returns. Yeah. So we want to maximize shareholders' value. Yeah. So with the NPV method, we want to choose the project with the highest dollars. Yeah. So the highest NPV. With the IRR method, we want to pick projects where the IRR is higher than the cost of capital, or projects where we have the highest IRR. Yeah. With the benefit costs ratio, we want to choose projects where the benefits outweigh the costs, and therefore we want to choose projects with benefits cost ratio larger than 1, right? When do they use inconsistent estimates? So when we have projects with different sizes, so the cash flows are of different sizes, or when the timing of the cash flows are different, then the IRR and the NPV method can be different. Yeah. In which case, we always pick the NPV method. Yeah. Okay, so we went through the 3 most commonly used methods of project evaluation, being the NPV method, the IRR method, and the benefit cost ratio, right? In the last part of the lecture, we look at evaluation methods where we don't use the time value of money. Yeah. So these methods have one thing in common: they don't use the time value of money, and they tend to be based on accounting figures. Yeah. So there are 3 methods that we focus on. We have the accounting rate of return method, So this is similar to the IRR. So the concept is similar to the IRR. We just use accounting numbers. Yeah. We have the payback period method. So this method gives us a time, right? So it gives us the time by which we recover the initial investment, right? We have the economic value added method, which is an average yearly value of the project. Yeah. Okay. So the accounting rate of return, as we mentioned before, is simply just a measure of the rate of return, but using accounting profits. Yeah. So we measure the average or the accounting rate of return by the average earnings divided by the average book value. Yeah. Or alternatively, we could also measure the accounting rate of return using average earnings divided by the initial book value, right? So these are both accounting numbers. Yeah. So given that this is a rate of return, right, this is the measure of the rate of return of the project, our decision rule is if the rate of return is greater than the minimum acceptable rate of return or the cost of capital, then we accept the project. Yeah. So the cost of capital here is the minimum rate of return that shareholders are willing to accept, are willing to invest in the project. If the ARR is greater than the cost of capital, the project is acceptable. Yeah. The problems with this method are firstly, so we're using accounting profits. So it's more or less, it's an accounting figure, right? So with accounting figures, it's a bit, it's backward looking, and it's also subject to management manipulation, right? So it's subject to different accounting changes, different accounting rules, and therefore it can be used to manipulate profit figures. Yeah. We also don't look at the timing of the earnings. We just simply take an average, yearly average of earnings, and we divide it by the book value of the assets. Yeah, so there's no timing differences. There's no adjustment for timings of the cash flows. Yeah. We have our second method, which is the payback period method. So with this method, we look at the time it takes for the initial cash outlay to be recovered from the project's after-tax net cash flows. Yeah. So how long do I have to wait until I get back my initial investment? Yeah. So for example, we have a machine, we invest in a machine that costs us $3 million, and every year the project is expected to pay off $1 million in the next 3 years. Yeah. So in this case, this is how our timeline looks like. So at today's time, we have to invest $3 million. So this is a cash outflow for us. After 1 year, we recover $1 million. Yeah. So the net income for us now is $2 million. Yeah. After year 2, we get back $1 million again, so that our net income is minus $1 million. Yeah. At the end of year 3, we get back $1 million again. So our net income here is 0, meaning that we recover the initial investment outlay after 3 years. Yeah. So with the payback period, we want to choose the focus of the payback period is to see how liquid the investment is. If we have a shorter payback period, that means that we get back our initial cash outlay faster, right? So if we were to have a maximum acceptable payback period, our decision rule here is to accept if the payback period of the project is less than the maximum acceptable payback period, right? So we want projects with more liquidity, yeah, projects that generate cash flows faster. Right, so this is how we work out the payback period for the project, yeah. If our cutoff period is 2 years, then we accept this project here because the payback period is less than 2 years. But if we choose a cutoff period of 1 year, then we reject the project, right? Because the payback is higher than 1 year. Okay, it's longer than 1 year. Okay, so the cutoff point here is a bit arbitrary. Yeah. We also have our final method, which is the economic value added method. So the EVA is the difference between the project's accounting profits and the required return on the capital, right? So what happens here is that we take the accounting profit and we adjust that for the amount of capital expected to commit into the project over the year. Yeah, so this is a yearly average number. So this is our profits. We then deduct the profits by the cost of capital, right? So this is the size of the invested capital, say $1 million. This is the average cost of capital per year, say 10%, yeah? So this method gives us a number. So this is like think of this like a value, right? So this is a dollar value. So what's the profits left after we account for the cost of capital invested in the project per year, yeah? So the return on investment after taking into account the cost of capital, right? So the decision rule here, given that this is a value estimate, right? It gives us a dollar value that the project generates every year, yeah? So the decision rule here is if the project's economic value added is larger than is larger than 0, then we accept the project, yeah? So this example shows us how to work out the economic value added from accounting earnings, yeah? So we just take the accounting earnings, we minus the amount of capital, the average capital invested per year, then we get the economic value added number. So in the next 2 slides, what we're looking at is 2 different surveys. So what these people do is that they go into, so they send out surveys to CEOs and CFOs, and they basically ask them what their preferred project evaluation methods are. and this is the response, right? So this number here shows the percentage of the CEOs or the CFOs that say that they use the accounting rate of return as a method for project evaluation, and so on and so forth. Yeah, so these are the percentage numbers. Yeah. So overall, we see that the internal rate of return and the net present value methods are the preferred methods. So about 75% of the firms, and this is a study in the US. So this is 75% of the firms in the US using the NPV method or the IRR method. Yeah. The payback period, despite all the problems and all the limitations, it is also quite popular, given that about 56% of the firms use the payback period, right? Also, we see that these numbers don't add up to 100. So if you add all these percentages up, it will be more than 100%, right? So it means that firms tend to use more than one method to price or to evaluate their projects. Yeah. Similarly, so we have this study here from 3 Australian academics, and what they did was they did a similar thing. So they sent out surveys to CEOs and CFOs in Australia, and they asked them which methods of project evaluation that the firm used, right? So in their response, we see a similar picture from before, which is that the NPV method and the IRR method are quite popular. So in Australia, about 94% of the firms use the NPV method, and about 80% uses the IRR method, right? We also see a very high popularity of the payback period, where 91% of the respondents say that their firm uses the payback period. Yeah. So that concludes our lecture, our module 1, part 1. So project evaluation methods. We will work through some examples of using these methods to evaluate projects in week 4. Thank you.